What's up guys, I want to show you something real quick. This is my portfolio of fund investments. This is the total that I have invested, and this is the profit that I've made over the last few years by investing in funds. I do nothing except for set up a standing order that automatically invests in various funds. It's hands off. I barely look at this, and this is a return that I've made on an annual basis, just under 11%. If you want to learn more about funds and how you can make these types of passive returns, watch till the end of this video and we'll get into the detail.
Hey everyone, welcome to Wealth Matters. I'm Warren, here to help you master your money and build your long-term wealth. Today, we're going to learn what a fund is, how a fund works, and how funds can benefit you and build your wealth over the long term. Do me a solid, guys, by hitting that like button and share this video with a friend that's also looking to build this wealth, and those likes and those comments really help. So, as you know, I make money from a few different sources: investing, side hustle, and property. That's several streams of income which bring me in just under £1,000 of additional income per month in addition to my salary. So when it comes to investing in the stock market specifically, I primarily invest via funds because they're passive. They're pretty much zero effort, guys. They earn me money whilst I'm sleeping, and they provide great diversification. And we're going to talk a lot more about diversification in the course of this video. But guys, funds are literally an armchair investor's dream, and I'm going to show you how they can benefit you. So let's start right at the very beginning. What is a fund? A fund is basically a combination of different stocks. For example, one of the funds that I invest in is called the Tech Digital Fund, which is made up of shares in tech companies like Facebook, Microsoft, Google, PayPal, Samsung, and other big digital companies. So by buying shares in this one Tech fund, I now own shares in all of these companies. I like to think of investing via a fund like the difference between playing for your local Sunday team, football, versus playing for a Premier League team. I was this close, guys, this close to being a footballer in the Prem. Everybody says that, doesn't they? But now, I ain't throwing shade on Sunday League. I spent most of my teens and my 20s playing in Sunday League. Some of the best weekends of my life. Your life as well if you're watching. Football on a Sunday, nothing like it. But when you're looking at a Sunday League team, don't know about you, but doesn't it seem like every other weekend you're struggling to find a goalkeeper with the hand-eye coordination to catch a ball and throw it, and you're always constantly in this struggle to find 11 players to start the match. Our team was just terrible. The amount of times we started with 10 players or 9 players. I don't know, maybe your Sunday League team is a bit more organized than mine was, but that was actually literally every weekend. Then you compare that, back to the analogy, but you compare that to a professional Premier League team where you always have 11 starters, plus all the stubs. You've got a manager, a defense coach, an attack coach, etc, etc. Everything's professional and well organized. It's a completely different ball game, guys, pardon the pun, but it's a very similar story when you compare hand-picking stocks to invest in, hand-picking individual stocks to investing, versus a professional organized fund. A fund employs analysts that can do them kind of Tony Stark equations in their sleep, and their sole job is to study the stock market day and night and make recommendations on the stocks that the fund should be holding, okay? They also have a fund manager whose sole job it is to achieve a certain annual return for all of the investors in the fund, i.e. you and me. Then you compare this to what most people do, right? With the best intentions, most people will buy and sell individual stocks based off of emotions, how they feel about a company, or speculation, what they've seen on the internet or in the news, rather than any professional detailed analysis. Guys, let's be honest. Tell me in the comment section below, how many of you have done at least 5 minutes, 3 minutes of research and analysis on a stock before you've gone ahead and bought it on Trading 212 or eToro or Free Trade? The reality is, unless you work in the finance industry or you've taken the time to educate yourself on the stock market and investing, it's hard to navigate and handpick individual stocks well. It's hard. That's why I choose funds, to make my life easier, guys. And funds are a great way to get around this. You're basically having someone do all of this essential work for you and reducing your risk of loss actually in the process. So what is a fund? A fund is a collective investment vehicle where people pool their money together to invest. Now this obviously produces a much wider, larger sum of money to invest in the market with. Most of us only have hundreds or maybe thousands if we're lucky to invest in the stock market, but by coming together in a fund and combining your money, we're talking millions or even billions. And funds are good for three key reasons, guys. The first is diversification that we mentioned earlier, which in really simple terms is not having all of your eggs in one basket and having different kinds of stocks within the fund, which reduces risk. So for example, if I have a portfolio of say £100 million and that's only invested in airline stocks, only airline stocks, and I don't know, say a global pandemic hits that prevents people from traveling all over the globe, I'm in big trouble, okay? Because those airlines are not going to be able to operate anymore and all of my stocks are going to crash. However, if I have investments within that 100 million portfolio, not just in airlines, but also say I have some pharmaceutical companies, tech companies, etc., all of a sudden I'm shielded from some of the impact that a struggling airline investment might incur. That really is the key. That example is really the key benefit of diversification, guys. It reduces risk and your risk of loss. Second are reduced costs of investing. Higher volumes, higher pools of money leads to what we call economies of scale because there's one single fund managing the investing activity for hundreds or even thousands of investors that are pooling their money together like me and you. So we can actually share the costs between us all, which is why the fees for funds tend to be a lot lower than for individual stock picking. And those costs, we're talking about admin charges for running the funds, a fund manager's charge, etc. And then lastly are reduced barriers to entry. So some investments actually require a minimum amount to participate. So say the amount was £10,000. On your own as an individual, that's hard to do, and you therefore won't be able to participate and buy those stocks. But collectively, when we're talking about millions or even billions of money together, pooled money, that's no longer a barrier. So we can participate in stocks and investments that we wouldn't be able to on our own. So now that we know what a fund is, let's look at how funds work. A fund ultimately owns the actual shares or bonds or the commodities within it. When you invest in a fund, you are buying shares in the fund, not the underlying shares, okay? And now the price of each share in the fund, generally speaking, should reflect the price of the underlying assets, stocks, bonds, etc. within it. So to illustrate this, let's go back to the example of the PicTech digital fund that I invest in. That invest in tech companies, as we said, you know, your Apples, your Googles, your Amazons, your Samsungs. Let's call that Fund A. And then say Fund B over here is invested in coffee. So, I don't know, companies like Starbucks or Costa Coffee or Pret, okay? I'd expect the shares of Fund A, PicTech, with the tech companies, to be more expensive than Fund B, investing in coffee companies. Why? Because the share price of tech companies such as Amazon, Google, Apple are higher than the share price of Costa and Starbucks. So that's what you'd expect to see, generally speaking. Now, if you're new to investing and you're just starting out, it's a good idea to start with what we call an open-ended multi-asset fund. That's a mouthful, but in very simple terms, we talked about diversification earlier on. It's a fund that's well diversified, okay? And therefore it generates steady or even good returns in a lot of cases, and it's much lower effort, lower risk. And just to flesh that out, when I say multi-asset, open-ended funds, we're talking about funds that invest in lots of different types of companies that are spread throughout the world. So you don't want a fund necessarily that only invests in American tech companies. You'd want a fund that invests in American tech companies, Asian tech companies, European tech companies. That's a diversification element that you want, which leads me on to my final point about funds, which is that you also have funds that specialize in different types of investments. I mentioned PicTech, the tech fund earlier on, but there's so much variation, guys. Funds are like Pokemon. There's one for everyone. So if you like to invest in tech, you can invest in a fund like PicTech. There's a fund for that. If you like to invest in tech companies, specifically in Asia, there's a fund for that. If you like cars and you want to invest in a fund that focuses on car manufacturers, there's a fund for that. Whatever you want, guys, it's out there. And in my next video, we're going to talk about how to research and pick the right fund for you. So look out for that video as well, guys. And another very important aspect of funds that you want to look out for, guys, and we mentioned this earlier, is the costs. Keep these to a minimum so that they don't cancel out your actual returns. Now, the key charges that you want to look out for are the ongoing charges figure. That should include all of the costs associated with the fund. So the fund manager's charge, the admin costs, etc. And you ideally want this to be less than 1%, because on top of that, there's also the annual platform charge. So if you're investing via a platform like Hargreaves Lansdown, Fidelity, etc. They're going to charge you a fee for using their platform because that's how they make money. They got to make money too. So ideally, you want to keep both of these combined to under 2% per annum. And 2% is high, to be honest, guys. I try and aim for below 1%. But under 2% an absolute maximum. So now you know what a fund is and how they work and what their benefits are. Hopefully this has demystified them a lot. If you have any questions or want to show your appreciation, drop me a comment and a like, guys. If you want to invest, guys, and you're looking for a platform or an app to invest via, I've included a link to eToro and Freetrade in the description below because you can get free shares and zero cost investing if you sign up via my links. You guys take care, share this video, see you next week.